Welcome to this Bell Direct monthly update. I'm Julia Lee, an Equities Strategist at Bell Direct. And for the month of July, it has been a positive one for the Australian share market, with the benchmark ASX 200 index up by 0.8%. And in fact, the blue chip index, the ASX 20, also gaining 0.8%. Where we have seen the difference is in the Small Ords Index, which is down 0.4%, and the Mid Cap Index, which is up by 1.5%. And both of these indices have been impacted by specific stocks. In the Small Cap Index, it's been impacted by Asaleo Care, which is down a massive 46% for the month, and Sigma Pharmaceuticals, which is down 43% for the month. In the mid-cap space, which outperformed, it was all about CIMIC, which is the second largest company by market cap in that index. And CIMIC delivered half-year numbers which were stronger than expected, propelling an expectation that we could see an upgrade to its full-year guidance. Let's have a look at the top and the bottom performers in the ASX 200 index for the month of July. And I guess firstly, most of the trends that we've already seen that have existed have continued here. We saw Afterpay clocking its third consecutive month of gains, up an impressive 59% for July. CIMIC also seeing its second month of gains, up 16.5% for the month. But Technology One, we saw a reversal of an existing losing run, with the market aware that it's one of the cheapest ways to gain exposure to technology on the Australian market. On the downside, though, we saw Sigma Pharmaceuticals losing a wholesale pharmacy contract, and that stock, the worst performer in the ASX 200. Bellamy's also coming under significant pressure, and Nufarm saw a profit downgrade due to the drought that we are seeing that has impact on its profitability and outlook. It was interesting to see the best sectors for the month, which were the telecom and healthcare sectors. These are traditionally thought of as defensive sectors. We saw telecom up by 4.5% for the month and healthcare up by 3%. And they were mainly impacted by the biggest stocks in each space. Telstra was up 4.6% in the telecom space, and CSL continued to gain ground, up 3.3% in the healthcare space. The worst performing sector was the utility sector on the back of government talk of making energy cheaper, and that impacted on the utility providers. But of course, in the month of July, we saw a number of concerns from the market. Number one was probably the trade war with the US and China. And I guess we aren't using the word war anymore, but more talk. And it has been downgraded a little bit in the minds of investors, given that we are seeing some stimulus coming through from China. But we have also seen a relatively strong second quarter US earnings season, which has helped the market. And confession season over here, we've seen positive reports coming through from Afterpay and CIMIC, and negative ones from Sigma Pharmaceuticals and Nufarm. But really what the market is grappling with at the moment is, are we seeing the market moving from rising inflation and rising growth to the next phase, which is rising inflation and slowing growth? This stage, of course, isn't as positive for equity markets, and this is what the market is trying to predict. I guess the market is still in a rising growth, rising inflation scenario. The worry for equities is the move into the next box, where traditionally we haven't seen this stage being quite as good for equity performance. So what are the signs investors should be looking for that we are entering into the next phase and we should be moving into more of a defensive stance? Well, first of all, the yield curve flattens. This is a bit of a blunt instrument though. Initially we did see the yield curve flattening in 2004, and it wasn't until 2007 and the end of 2007 that we did see the market really significantly starting to see declines. We should also see the market breadth narrowing, and that means the number of stocks participating in the market rise starts to fall. Then you start to see defensive sectors starting to outperform as investors move from growth to defensive, and also economic growth looks to move below trend. So these are some of the factors you should be looking for to perhaps start that move into more defensive strategies as the macroeconomic cycle turns. Of course, for the Australian share market, the next important milestone is the August reporting season. And going into this season, mainly positive on traditional media like Fairfax, 7 West Media, as well as Nine Entertainment. This should be the first year that we start to see positive performance from the growth in revenue from the advertising space that we have seen in a number of years. Also positive upgrades. These are the companies that have upgraded during convention seasons, stocks like ARB, Aristocrat Leisure, CSL, as well as Qantas. Also overweight energy and commodities, given that during the last period we have seen rising commodity prices and a falling Aussie dollar, which should be good news for profitability. But cautious and looking for a possible inflection point around Australian housing. And some of the stocks that may be impacted here include stocks like CSR, Nick Scali, as well as Harvey Norman. And the outlook statements are going to be key here. Of course, a number of companies have already come out with negative outlooks for this reporting season, and they include stocks like AMP, Amcor, Retail Food Group, JB Hi-Fi, Green Cross, as well as Ramsay Healthcare. So remaining quite cautious towards these stocks and underweight heading into reporting season. I hope you've enjoyed the monthly update. It's been a positive month for Australian investors. However, now is coming the all-important full-year reporting season in August, where we will see a lot of portfolio managers resetting portfolios on the back of the results that come out from the Australian share market, as well as the outlook statements. I'm Julia Lee, an equity strategist from Bell Direct. Hope to see you next month.